Right now, while you're watching this, one of the world's quietest financial superpowers is making a decision that could unravel the entire American economy. And most people have no idea it's even happening. Something extraordinary just happened in the currency markets. In a matter of hours, the Japanese yen surged more than 1% against the US dollar. On the surface, that might sound like routine market noise. Currencies rise and fall every day. But this wasn't routine. This was different. Traders across Tokyo, London, and New York began whispering the same thing: intervention. The kind of intervention that only happens when governments decide the stakes are too high to let markets move on their own. And they were right to whisper. Because what's unfolding right now isn't just about exchange rates or central bank maneuvers. It's about power. It's about dependency. And it's about the slow, methodical unwinding of a financial relationship that has quietly held up the American economy for more than half a century. Most news outlets are treating this like a blip, a temporary spike, a market overreaction, something that will settle down by next week. But that lens is dangerously narrow. What we're actually witnessing is the beginning of a historic shift in global capital. Trillions of dollars are on the move. Decades-old investment strategies are being abandoned, and the financial architecture that once made the United States the undisputed center of the world economy is starting to crack. To understand why this matters, you need to understand Japan's role in the global financial system. For generations, Japan has been America's silent partner. While China grabbed headlines and Europe debated its future, Japan quietly funneled vast sums of money into U.S. Treasury bonds, corporate debt, and real estate. Japanese pension funds, insurance companies, and banks became some of the largest buyers of American government IOUs. They didn't do this out of charity. They did it because it made financial sense. Here's how it worked. Japan's central bank kept interest rates near zero for decades. Borrowing money in Japan was almost free. So Japanese investors developed a simple, profitable strategy. Borrow yen at home where it cost almost nothing, convert that yen into dollars, and then invest in higher-yielding assets abroad, especially in the United States. American government bonds paid more. American corporate debt paid more. Even American real estate offered better returns than anything available domestically. It was a win-win. Japan earned higher returns and the United States got a reliable, massive buyer for its ever-growing debt. This arrangement became so embedded in the global financial system that most people forgot it was even there. It was just background noise, the way things worked. But every system has a breaking point, and Japan is now approaching its own. Here's what changed. For the first time in decades, inflation in Japan is no longer theoretical. It's real, it's persistent, and it's hurting ordinary people. Prices at grocery stores are climbing. Energy costs are rising. Households are feeling the squeeze. And when people feel economic pain, they demand action from their government. Politicians respond. In Japan's case, that response has taken the form of increased fiscal spending. More government programs, more subsidies, more infrastructure investment, all of it designed to ease the burden on citizens and stimulate the domestic economy. But there's a problem. Japan is already one of the most indebted nations on the planet. Its government debt-to-GDP ratio is among the highest in the developed world. And when a heavily indebted government decides to spend even more, it has to borrow that money. So Japan has been issuing more bonds, a lot more. And when you flood the market with new bonds, something predictable happens. Yields start to rise. Now, yields are just the interest rate the government has to pay to convince people to lend it money. For years, Japan's bond yields were stuck near zero because there was no inflation and no growth. But now, with inflation creeping up and the government borrowing heavily, investors are demanding higher returns. Japanese government bond yields have been climbing at a pace that's caught even seasoned analysts off guard. And this is where the entire logic of the old system starts to break down. Think about it from the perspective of a Japanese pension fund or insurance company. For decades, you've been sending money overseas because Japanese bonds paid almost nothing. But now, suddenly, Japanese bonds are offering real returns again. You can earn a decent yield without taking on currency risk, without navigating foreign regulations, and without worrying about geopolitical tensions. The safe, stable, familiar option is starting to look attractive again. So what do? You start bringing money home. You stop buying as many U.S. treasuries. You let your foreign holdings mature without reinvesting. Slowly, methodically, you shift back toward domestic assets. This is not a panic. This is not a crisis. This is a calm, rational reallocation of capital. But the consequences are enormous. There's another piece to this puzzle, and it's arguably even more important: the carry trade. This is one of the most powerful forces in global finance, and most people have never heard of it. So, here's how it works. For years, hedge funds, banks, and sophisticated investors borrowed enormous amounts of yen at near-zero interest rates. They then converted that cheap yen into dollars, euros, or other currencies and invested in higher-yielding assets around the world. As long as Japanese rates stayed low and the yen stayed weak, this trade was, well, essentially a money-printing machine. You could borrow for almost nothing and earn a healthy return elsewhere. The difference was pure profit, but this trade only works under very specific conditions. The moment Japanese interest rates start to rise, the cost of borrowing yen goes up. And if the yen starts to strengthen, the value of your foreign investments falls when converted back into yen. Suddenly, what was once a safe bet becomes a losing proposition. And when that happens, investors do the only rational thing: they exit the trade. They sell their foreign assets, buy back yen to repay their loans, and walk away. This process is called unwinding. And when it happens on a large scale, it creates a feedback loop. Selling foreign assets pushes those prices down. Buying yen pushes the yen up. A stronger yen makes the trade even less profitable, which forces more investors to exit, which pushes the yen even higher. It's a self-reinforcing cycle. And right now, that cycle is starting to spin. The recent jump in the yen wasn't just about intervention rumors. It was also driven by investors scrambling to close out positions that were becoming too risky. And as this unwinding continues, it's going to put enormous pressure on global asset prices, especially in the United States. Now let's connect the dots. Japan is the largest foreign holder of U.S. Treasury securities. As of the latest data, Japanese institutions hold well over $1 trillion in American government debt. That's not a small number. That's a foundational pillar of U.S. government financing. Every time Japan needs to defend its currency, it has to sell assets. And the most liquid, most accessible asset it holds is U.S. Treasuries. So when the yen weakens too much and inflation pressures build, Japan's central bank and finance ministry have a clear playbook: sell dollars, buy yen, stabilize the currency. But every time they do that, they're pulling liquidity out of the U.S. Treasury market. Here's where it gets interesting. Analysts at Goldman Sachs recently published research showing that for every 10 basis point increase in stress within Japan's bond market, U.S. Treasury yields rise by approximately 2 to 3 basis points. Let that sink in. Decisions being made inside Japan about domestic spending, domestic inflation, domestic bond issuance are directly influencing borrowing costs in the United States. Tokyo is effectively tightening financial conditions in Washington without ever intending to. This is not something U.S. policymakers can control. They can't vote on it. They can't negotiate it away. They can't pressure Japan to stop, because Japan isn't acting out of malice. It's acting out of necessity. It's protecting its own economy. And in doing so, it's exposing just how dependent the United States has become on foreign capital. There's a term for this kind of vulnerability: fragility, and the Federal Reserve knows it. In late January, something unusual happened. The Federal Reserve conducted what's known as a yen rate check. This is not a routine procedure. It's not something the Fed does casually. In a yen rate check, the Fed reaches out to major banks and asks them about conditions in the currency market. It's a way of gathering intelligence. But it's also a signal. It tells the market that the Fed is paying very close attention. And in this case, analysts interpreted it as something more, a sign that the Fed and the Bank of Japan might be coordinating behind the scenes to support the yen. Why would the Fed care about the yen? Because if Japan is forced to aggressively defend its currency by dumping U.S. treasuries, it could trigger a spike in U.S. interest rates. Higher rates mean higher borrowing costs for the government, for corporations, for consumers. It means tighter financial conditions at a time when the U.S. economy is already slowing. The Fed doesn't want that, so it's trying to head off the problem before it spirals. But here's the uncomfortable truth. The fact that the Fed felt compelled to step into currency discussions at all reveals just how fragile the system has become. The United States is supposed to be the world's financial superpower. Its currency is supposed to be the ultimate safe haven. And yet, here we are, with the Federal Reserve essentially trying to prevent one of America's oldest allies from selling its bonds. That's not strength. That's desperation. And Japan is not alone. What's happening with the yen is part of a much larger story. The slow erosion of confidence in the US dollar as the world's reserve currency. Look at the data. In mid-January, global equity funds saw record outflows of over $43 billion. Nearly $17 billion of that came from U.S. markets specifically. At the same time, gold prices exploded past $5,000 an ounce, briefly touching $5,100. Silver crossed $100 for the first time in modern history. These are not normal moves. These are the kinds of moves you see when investors are losing faith in the traditional anchors of the financial system. For decades, geopolitical turmoil strengthened the dollar. Wars, crises, uncertainty, all of it sent capital flooding into U.S. assets because they were seen as the safest place to park money. But something has changed. Today, when tensions rise, investors are increasingly turning to gold, silver, and other hard assets instead of the dollar. That's a fundamental shift in behavior, and it tells you everything you need to know about where confidence is heading. The numbers are stark. In 2025, the US dollar fell more than 9%, its worst annual performance since 2017. In January alone, it dropped another 2.2%. Over the past 12 months, the dollar index has declined nearly 11%. Currency strategists are now openly calling this a bear market, and they expect it to continue. Money is moving. Canadian banks are seeing inflows as investors look for stability in North America outside the U.S. European financial sectors, long overlooked and undervalued, are attracting fresh capital. Resource-rich economies are suddenly back in favor. The pattern is clear. The world is diversifying away from dollar dependence. So what's driving this? Well, there are really two things at play here. First, the weaponization of the dollar. Over the past decade, the United States has increasingly used its control over the global financial system as a tool of foreign policy. Sanctions, asset freezes, exclusions from payment networks. These have all become standard tactics. And while they may serve short-term political goals, they come with a long-term cost. Every time the U.S. uses the dollar as a weapon, it gives other countries a reason to reduce their reliance on it. It's honestly a slow-motion own goal. Second, the explosion of U.S. government debt. Deficits are soaring. Debt is accumulating at an unprecedented rate. And, there's really no serious plan to address it. When investors look at the trajectory of U.S. fiscal policy, they see risk. They see a government that's spending far beyond its means, with no obvious path to sustainability. And so, they start hedging. They start looking for alternatives. The combination of these two forces, political weaponization and fiscal recklessness, is undermining the very foundation of dollar dominance. And Japan's shift is both a symptom and an accelerant of that decline. So where does this go from here? Japan is not going to trigger a sudden financial collapse. That's not how this works. Tokyo has no interest in destabilizing global markets or punishing the United States. But even a gradual, controlled repatriation of Japanese capital will have profound effects. U.S. interest rates will climb as demand for treasuries weakens. Borrowing costs for the government, for businesses, for homeowners will all rise. The dollar will likely continue its decline, making imports more expensive and feeding inflation. And, the feedback loop will tighten. There are a few key signposts to watch. The first is Japan's upcoming snap election on February 8th. If the current coalition maintains or expands its majority, expect fiscal stimulus to accelerate. That means more government borrowing, higher bond yields, and stronger incentives for capital to stay home. If Japanese yields continue climbing over the next 3 months, that's your confirmation that repatriation is gaining momentum. The second signpost is the dollar index. Right now, it's hovering in a critical zone. A decisive break below 94 could open the door to a move into the low 90s or even the high 80s. That would represent a major psychological and technical shift. The third is gold. Goldman Sachs recently raised its forecast for December 2026 to $5,400 an ounce. If gold continues its ascent, it's a clear signal that investors are fleeing paper currencies in favor of hard assets. This is not just about Japan. This is about the end of an era. For more than 70 years, the United States has enjoyed what economists call an exorbitant privilege. Because the dollar was the world's reserve currency, the U.S. could borrow cheaply, run deficits without immediate consequences, and fund its military and social programs on the back of global demand for its debt. That arrangement made America the richest, most powerful nation on earth. But that privilege was never guaranteed. It was earned through trust, stability, and economic dominance. And when those things erode, so does the privilege. What we're seeing now is the slow, inevitable consequence of decades of policy choices. The decision to prioritize short-term political wins over long-term fiscal responsibility. The decision to weaponize the financial system without considering the blowback. The decision to assume that American dominance was permanent. It wasn't. And now the bill is coming due. Japan is reclaiming its financial independence. Other countries are watching closely and considering their own options. The global financial order is being rewritten in real time, and the United States, for the first time in generations, is not writing the script. The real question isn't whether this transformation will happen. It's already happening. The question is how fast it unfolds, and whether American policymakers will recognize the urgency before it's too late. Because right now, America's largest creditor is changing course. The foundations are shifting, and the world is beginning to imagine what comes after American financial dominance. The yen's sudden surge wasn't just a currency move, it was a warning shot. And if you're paying attention, you can hear the echo.